What's up, guys? Video information here. So, Costco Analysis. Costco has a PE of 30.82. And for all of these, the lower the better, we'll just say. All right, let's just focus on the lower they are, the better in comparison to revenue and market cap. Sorry, I have to figure out how to make these videos like this without constantly making the letters pop up. But anyway, PE of 30.82, PB of 7.5, a PS of 0.68, and a DE of 0.52. Now, quick run over. Price to earnings is what PE stands for. So that's the price of the stock over their basically EPS, their average EPS. Then you have their price to book ratio. That's its price over comparison of its book ratio. Then you have price to sales, which is basically price of the stock over sales. And then you have its debt comparison to its equity. And you could basically put a slash like you're dividing, because that's the numbers that you would put over one another, if that makes sense. Then you have the revenue. They've had 141.6 billion yearly, up 9.7% growth over last year. And then you have a market cap of 96 billion. So 141.6 billion in comparison to a market cap of 96 billion. It's undervalued. That's what I would call that. When it's generating more revenue, I would consider that undervalued as a value investor standpoint. And it has a pretty, you want it to be lower than 0.5 on average, but 0.52 is still really good for a company pulling in that kind of revenue, especially when it's bigger than its market cap. And they have a very low price to sales, as well as their PE, kind of expensive, but I feel like each earnings are just going to get better and better because they're expanding. People really like Costco. But anyways, I'm straying too much. Target, we have a PE of 14.8, a price to book ratio, because I'm comparing it now, of 4, a price to sales ratio of 0.62, and a debt to equity of 1.08. So debt to equity is twice as big. I don't like that. Price to sales is a little bit smaller. Price to book ratio is smaller. And then its PE is obviously smaller, but they're only pulling in 74 billion a year. That's half of what Costco's pulling in, and they only have 6.3% growth, as well as a 44.5 billion market cap, which once again I would call that undervalued. So if you're just value investing, then you could invest in both of them right now, and I'd say you probably would make a decent return the next 5 years. Target, I think, really has secured the moms and just like the females into getting into the stores, versus like Walmart, they're trying to get everybody, so is Costco. But anyways, now going to the big dog, Walmart, we have a PE of 53.63, pretty big, a price to book ratio of 3.83, price to sales of 0.54, and a debt to equity of 0.69, which is really good considering how big the company is. 510 billion annual revenue. So like, I can't say much about that. That is really crazy, but the PE is exceptionally high, and I'm just like, I would still invest in it if I just had a bunch of money to start throwing. I would get that, as well as more shares of Microsoft. I don't have Microsoft at the moment, but right now Walmart and Microsoft are having a collaboration where they're going to be getting rid of cashiers and having the automatic ones that'll just scan your items and automatically just have you pay. I think that will help a lot more people stop shopping on Amazon and just go and get quick things from Walmart, because that's the issue. People don't want to wait. I don't want to wait. And that's why I would rather order online. So once that changes, I think the revenue will go up even more, and it'll just be crazy. They might hit one freaking, I'm not going to say let me stop. I was about to say 1 trillion, but that's too much. 4.2% revenue growth. So not bad considering how big the company is. And then you have 273 billion market cap. So once again, I would call that undervalued, but the price to earnings, that makes it hard to argue, because they're not getting much of that of the revenue turned into earnings, which is why if they get rid of all the cashiers, that expense would be cut significantly. Then you have Kroger with a PE of 6.6, a price to book ratio of 3.14, price to sales of 0.2, and then a debt to equity of 1.65. They have 124 billion annual revenue. That's only 4.1% growth. So the smallest percentage growth in the group, but they're pretty close to Costco. They're bigger than Target and not even close to Walmart. None of them are even close to revenue in Walmart. And then you have $23.2 billion. So hugely undervalued in my opinion. Very low price to earnings, market cap, but I wouldn't invest in them. I would invest in Costco, Walmart, Target, Kroger in that order, just because Kroger, yeah, it's probably going to grow, but like I don't see why it would grow faster than the other three companies that I just named before it. But anyways, that's my list. What do you guys think? And thank you so much for watching. Feed You Information, out.